Hello, learners. Welcome again to our session. So in our session is a continuation of what we were doing earlier on. So today I want us to look at a whole different question, again from our past paper. Remember, the concept of discounting techniques is always very wide and very important. And that's why you are seeing us doing so many questions, to make sure that you grasp each and every concept when it comes to the discounting techniques. So today I want us to attempt a question. This question was tested in May 2018, question number 4, part C. And the question basically is a concept to do with the net present value, but you are given an area whereby you are supposed to advise the management in various cases. So these are a question, my good students, these are a question. May 2018, question 4C. May 2018, question number 4C. So first of all, we are asked to work out types of capital rationing in capital budgeting. Remember, anytime you are talking of types of capital rationing in capital budgeting, we normally tend to talk of only two types of capital rationing. That is the soft rationing. We normally tend to talk of types of capital rationing, Anytime you're asked to give types of capital rationing, basically you normally tend to talk of two. That is soft and hard. So number one, you normally tend to talk of soft capital rationing. And number two, we normally tend to talk of hard capital rationing. The concept of rationing, I know maybe, very common at times. You'll find that KPLC, they want to ration some electricity in various parts. And whenever talking of rationing, basically, it will bring a fact that it's not enough. If something is not enough, that's why you are going to ration, right? That's why you are going to ration, mean that it is not enough. So looking at this concept of capital rationing, basically, the main concept that we normally tend to consider is that at this point, we want to look at an investment. And investment probably will require various capital, or rather will require actually the capital that you need to invest in. So at times this capital might not be enough. So soft capital rationing will come into place, whereby we are looking at the internal factors that will limit us to achieve the required capital. These are basically internal. These are kind of internal barriers that will limit us for us to achieve our capital required. So soft basically is all about internal barriers. Things that internally this will hinder us, internally this will prevent us, internally this will act as a barrier for us to achieve whatever that you want to achieve when it comes to capital. That is soft capital rationing. Hard capital rationing, look at it as external barriers that will hinder us to raise the enough or required capital for us to invest in. Say for example, like maybe I need to invest in a certain project, and investing in this project will require a certain amount. I'll decide and say that I want to go and take some loan, maybe from my commercial bank. At this point, because of probably I don't have enough assets, or maybe you don't have enough collateral, you'll find that I'm going to be limited up to a certain amount. So this is a good example of external rationing. This is a good example of external barrier that will hinder us to raise enough capital. So in a very simple manner, whenever we're talking of soft capital rationing, just understand that these are what internal barriers that will limit us to raise the enough or required capital. Whereas hard capital rationing, these are the external factors that will hinder us for us to achieve what? The required capital. Basically, that is how we can differentiate between a soft capital rationing and a hard capital rationing. So after we have understood that, the next element that I want us to go is part B of the question. Basically, that is what you're required to do in that bit. Now, the other case, these are what we have. So we've handled part C1. Part C2, these are what you are told that Amani Contractors Limited is intending to invest in 4 independent projects. The information relates to the 4 projects, A, B, C, and D. I'm given the present values of cash flows in millions. Initial outlay I'm also given there. I'm also given the net present values. Of course, you're talking of present value minus initial outlay. That will give us our NPV. Additional information, you are told that the company has a capital limitation of 90 million. Mark that very well. The company has a capital limitation of what? 90 million. I'm having a limitation of 90 million. The company's required rate of return is 10%. The company's required rate of return is 10%. Any surplus funds can be reinvested to generate a return of net cash flow of 14% in perpetuity. Annuity, right? Perpetuity, annuity. The projects are indivisible, meaning that we can't do this and live, meaning that they are indivisible, right? The projects can be combined to achieve a higher return subject to the company's capital limitation. The projects can be combined to achieve a higher return subject to the company's capital limitation. Required, we need to advise the company on the optimal project combination. So many a times, if we are to advise the company on the optimal project combination, basically, we look at the project that if we combine, will give us a higher net present value. That is one thing that you can use to kind of what? To advise the company. Look at these two projects or three projects that we combine. Basically, we normally tend to talk of too many at times. Two projects that we're going to combine that will give us a maximum net present value. So out of our combination, I'll look at the projects that we've combined and is giving us what? A higher net present value. And in that case, we also told that we can do what? We can reinvest in excess. Assuming at this point I've determined our we can always kind of come and determine the surplus. Maybe we've assumed that the initial cost, maybe I'm having a certain amount. After you do have a certain amount, there's an amount that you can reinvest. So that's why the examiner is giving us what? Any surplus funds can be reinvested to generate a return of net cash flow of 14% in perpetuity. So in this case, my good students, first of all, you need to advise on the optimal project combination. And the optimal project combination, of course, I'm going to look at what? We are going to look, of course, that we are going to talk about aspect of the projects that if we combine, of course, will give us what? A maximum, or rather an optimum. Talk about an optimum NPV, an optimum NPV. So that is to say, we should be talking of, the following. That is to say, we should be talking of the following. I'm having the four projects. Kindly, I'm waiting for you guys to take a screenshot of that question. Still, Mwalimu can squeeze it somewhere here. So, given such a question, the good thing is that already we have a concept of NPV. So things will be kind of not hard on us. So let us try to work it out together. So I'm given different projects. I'm given four projects, which in this case you need to kind of see the one that will give us our optimum NPV if we do what? If we combine. So to start with, I'm given our project. Let us see the best combination that you can have. We start with project, assuming we do combine project A and B. So these are project combination. For project combination, assuming combine project A plus B, we can combine A and C, and we can also combine A and what? D, right? That is a combination, the first combination. The other combination, you can combine B and C, right? Given our facts, looking at it, we can combine B and C, right? We can either combine B and C. We can combine B and D. These are a bit of a combination that we are looking at. Or still at this point, you can combine what? C and D. You can combine, of course, C and D. So I can either combine A and B, B and C, A and D, or you can combine B and C, or B and D, or rather you can have C and D. I think we've looked at all combinations that you can have. B and D, we have it. B and C, we have it. C and D, we have it. A and C. So I think we've just looked at the whole combination. What Mwalimu is doing, I'm just taking the way they are. Like I'm looking at that point where we do have project A and B, A and C, A and D. You can either take, of course, B and C, B and D, or you can take C and D. And of course, also you've talked of what? Aspect of B and D. So these are the projects that we are looking at, the combination. Just look at whatever that I was given there, our projects. We're just looking at ways that we can combine them, right? Then after that case, remember our focus is that we need to advise based on the net present values, right? So we proceed and see what you are given. We proceed and see what you are given. We proceed and see what we were given at that point, what you are given at that point. So having that, we want to look at the total initial outlay, the cost of our combination. So these are initial outlay. Initial outlay. Initial outlay, what is the cost of A and B? The cost of A and B, I can see the initial outlay here. I'm having a figure of how much? Initial outlay I'm given 30 and 45. Kindly just check it out slowly, 30 and 45. A and C, I'm having initial outlay of 30 and 60. 30 plus 60. The other one I'm having 30 and 60. The other one I'm having A and D. A and D I'm having 30 and 40. B and C we have 45 and 60. B and D, I'm having B and D that is 45 and what? I'm having 45. 45 of course, and we do have 45. B and D, I'm having 45 and 40, right? Then C and D, I'm having 60 and 40. So basically, those are the combinations that you are given. Kindly confirm with Mwalimu. Kindly confirm. Those are the combinations that we do have. So the moment we do have that bit, the moment we do have the combination, that will give us a total of how much? So we have here 30 and 45. 30 plus 45 to give us 75. 90. 70. 105. 85. 100. I want you guys to confirm. Remember our figures here are in millions. Our figures are in millions, right? So the moment you have our initial outlay, meaning that if we combine either of the projects, that is the cost that you're going to incur. That is the cost that you are going to incur. Let us proceed. Pole, till you guys understand this concept clearly. The next bit is, did you have our NPV, the net present value of these projects, were we given? Of course, you are given our net present values. So again, let us combine our net present value and see what we'll have. Combine our NPVs. Combine our net present value. Our figures, remember, are in millions. So if you combine our net present value, of course, just look at that case was given. Net present value for A and B, I'm having a figure of 20 and 15. A and B, we have 20 and 15. A and C, I'm having 20 and 40. A and D, I'm having 30 and 40. Not 30 and 40, but I'm having 20, 15. I'm having 20 and 40. We do have A and D. A and D, I'm having 20 and 30. Then BC, I'm having 15, 40. BC, I'm having 15, 40. 15, 40. Then we do have BD. BD. BD, I'm having 15, 30. CD, we have CD. I'm having CD. We do have, of course, CD. CD, we do have a figure of format there. We do have a figure of present values. Sorry for that. I'm having a figure of 15 and CD. 15 and 30, right? BC 15, 30. Then the last one, talk of CD. Let me check my question. My question has disappeared on my phone. We are having there a figure of CD 40 and 30. We do have 40 and 30. 40 and 30. So we do have a 40 and 30 at that point. 40, 30. 40 and 30. So that is what you are given as our NPV. That is what you are given as our NPV. That is what you are given as our NPV. Now, the moment you have that case, I think things will now be very simple, because determine our total NPV. Determine our total NPV. So I'm having it at that point. Determine our total NPV. So our total NPV, that will be simple, because I'll be having this case 20 plus 15 within, I'm having 35, I'm having 60, 20 plus 30, I'm having 50, I'm having 65, not 65 but 55. We do have 45, and we do have, of course, that should give us, of course, 70, right? That should give us 70, that should give us 70, right? So these are our analysis. Up to that point, you can do our analysis clearly. Up to that point, my good students, I want us to do this analysis, and I want you guys to understand it very clearly here. Up to this point, you can now do our analysis. You can now do our analysis. And doing our analysis, look at this case. My capital limitation is how much? Our capital limitation, you are given a figure of capital limitation. You are given a figure of 90, right? Capital limitation, I was given a figure of what? 90. I was given a figure of 90. I was given a figure of 90. So that is to say that I can't invest. I want to rule them out. I can't invest in this combination with the whole thing, simply because look at my initial outlay. Initial outlay is 105. And what did we have as our limitation? We were given 90, right? I can also not invest in this because already it has surpassed our 90 mark. So the only combination that have remained which you can invest in are either the combination of this combination, this, or this one. So I can either invest on these combinations. I can either invest on this combination. That is aspect of this combination. We've ruled out the two combinations simply because you can see the initial outlay is surpassing our capital. And remember, we were only limited to 90. So it is surpassing our 90 million mark. So in this case, we can determine our surplus investment. Talk of our surplus in each. If I was to invest in this combination of A and B, what will be my surplus? I'm having 90, what we have. 90 minus 75, initial outlay will be 75. The other one I'm having initial outlay, which is 90 minus 90. The other combination I'm having 90 minus 70. At this point, we've ruled out this one completely. We won't invest on that. In this case, I'm having a surplus of 90 minus 85. So we can determine our surplus that we can invest in. So that should give us how much? The first one I'm having a surplus of 90 minus 75 to give us a surplus of 15. This should be 0, this should be 20, and this should be what? 5. So these are our surplus. We can invest our surplus. We can invest our surplus. So up to this point, this is what I want us to agree and understand each other. I can now remove this question because at this point, to explain this bit, that the first thing that we've done, we've determined our combination. The other thing that we've done, we've determined the total cost of this combination, subject to the limitation that I'm only having what? 90 million, right? So we ruled out the combination that gave us more than what we have. We can't invest in what we don't have. Then, looking at the same combination, I'm having 90. There are these projects that I won't invest the whole amount. I'll be remaining with the surplus. And this surplus, we can do what? We can reinvest this surplus. We can reinvest this surplus. We can reinvest this surplus. And basically, these are the surplus that we had. These are the surplus that remained. So at this point, it will also be upon us to determine, my good students, the net present value of this surplus that you are going to do or that you're going to reinvest. What will be the net present values of this surplus that you're going to reinvest? That will be very simple because this is what we'll be required to do. I'm going to determine our reinvestment. We are going to determine the present value that you're going to earn in our reinvestment. And how will we work it out? That will be simple, my good students, because these are what we'll be required to have. This is what we will be required to have. We need to determine the NPV of reinvesting what? This surplus. What will be the NPV? What will be our net present value? Net present value of reinvesting our surplus. What will be our net present value of reinvesting our surplus? The net present value of reinvesting our surplus will be as simple as this. What will be our new rate of return if we reinvest our surplus? The examiner was very good, and I think he had given us here. Check out note number. We are told somewhere in note number 3. Any surplus funds can be reinvested to generate a return of net cash flow of 14% in perpetuity. We are all in note number 4. Where we are told that any surplus funds can be reinvested to generate a return of net cash flows of 14% in perpetuity, annuity. So I know majority will ask Mwalimu then, how will you determine that present value of that amount? That will be very simple. That will be very simple. And these are what you need to understand, that at this point, for each component, remember these are our excess, these are our surplus. So like if we are to talk of the first combination A and B, if you are to talk of the first combination A and B, my surplus is 15. And what was the previous discount factor? The previous discount factor, we were given what percentage, by good student? Or I should just leave this question here instead of, let me have it here. Go to note number, we are told that note 2, the company's required rate of return is 10%. The company's required rate of return is 10%. So that is to say that the 15, the one that you are getting, the 15, that was of 10%. If we reinvest, our return will be 14%, because we aren't given the aspect of the duration of investment and all that. So I'm taking it in this case, you're seeing that the 15 million, the initial, this amount that you are looking at, that is on the discount rate of 10%. So what will be our 14% if we reinvest that? That is to say my present value of 14% will be how much? I'll just be taking here, this case, I'll just be taking 15 by 14. We divide by 0.1. That is, of course, that is 15, the first case. 15 times 14, we divide by 10, right? To give us 21. So we can agree my present value is 21. Our initial outlay, I'm investing 15 million. So that is to say, I should be talking of 21 minus 15 to give us what? 6. So my NPV, I should be having 6. This combination of A and C, what do we have in excess? I don't have any amount to invest. So therefore, in this case, new NPV, or rather reinvestment NPV, our initial NPV, we had initial NPV for the first case, we had initial NPV of what? 35, right? We had initial NPV of 35. So if we are to talk of our total net present value, what will we be having? I should be having 35 plus 6 to give me 41. On this other case, combination of A and C, I won't reinvest. So my new NPV, I won't have anything there. So initial was 60, total will just give us what? 60. Combination of A and D, combination of A plus D, in this case, the same case I'm going to ask myself is, if at all at this point, 20 initial investment had a return of capital of 10. What about 14? That should give us 20 by 14. We divide by 10 to give us 28. Initial outlay, I am reinvesting 20. So NPV will be 8. Present value minus initial outlay to be 8. Initial NPV at this point, we had our initial NPV of what? We had an initial NPV of 50. So therefore that should give us 58. Total net present value. The last one, the last combination is B and D. B and D. For B and D, the same concept I'm going to ask myself is, the 5, the one that we are reinvesting, was 10. What about new of 14? So 14 by 5, divide by 10 to give us 7. Initial outlay is 5. So that is to say my NPV will be 2. We add our initial NPV of 45 to give us a total of 47. So that is to say, my good students, let me remove this bit. Yeah, this is what you are getting after adding. Just a matter of adding that, right? Our new NPV plus the initial NPV. So my total NPV of plus the one that we are going to reinvest, these will be our total NPVs. So my good question is this case. What is the combination that will give us the highest net present value? The combination that will give us the highest net present value. The combination that will give us the highest net present value, can all agree that it is what? 60. This is a combination that will give us the highest NPV, and therefore we can advise the management to invest in which project and which project. We can advise the management to invest in project, of course, project A and what? Project A and B, project A and C. The best combination will be A and C, right? Because that's where we're having the highest NPV. This combination. So the best combination to invest in, the best combination, my good student, to invest in is A and C, A plus C. Because at this point, it will give us the highest NPV. It will give us the highest NPV. It will give us the highest NPV. And basically, that is what we are required to do in such an event. Remember, this is the concept of NPV, but they are bringing it in a whole different angle. So basically, that is what will be required to do in that case, my good students. Okay? That is what will be required to do in that case. So up to that point, thank you so much, guys, and let us meet in the next session. We are going to handle part C of that question. Part C of that question, or we can just handle it at this point. Part C of the question, let me see if we can handle it at the same time, or we handle it in the next video. So basically, these are what you're told. Aspect of D. Let us handle this in our next video. To that point, guys, thank you so much, and let us meet next. Thank you.